Hi, I'm Adrian Helfert, CIO of Multi-Asset for Westwood. Thank you for joining me today. Certainly on investors' minds are the increased volatility that we are seeing in markets currently. One of those things that's been driving that volatility and the questions we're getting from investors are around inflation. They're around what's happening with the Federal Reserve. The Federal Reserve last week hiked base rates by 50 basis points. That's what we would term as two hikes all in one. That's because they're trying to control inflation. The concern is what this means for markets, what this means for the housing sector, where mortgage rates are rising significantly, what this means for growth, for economic growth. Does the Fed say it's pulling the punch bowl from the party mean that we expect to see lower growth and a recession in the next 2 years? The consensus is that we are going to see lower expected economic growth, and that's what our models tell us as well. Certainly, there are things that investors should be thinking about in context of this environment. One of those is that interest rates are rising. And when interest rates rise, that generally means there's a higher discounting rate on some of these very growthy technology-oriented companies. That's one thing that has been a paradigm this year, that technology has underperformed dramatically, that the growth equity style has underperformed dramatically value equity. Value equity often is characterized by higher free cash flow in the near term, shorter term cash flow profiles that have less concern about achieving a longer term cash flow profile. Us as investors have looked at this and been more value equity style in our funds as we have expected interest rates to be rising. Now, as we see prospective economic growth start to come down, we expect interest rates will likely level out, if not at some point in the intermediate and longer term, so I think 10 years and 30 years, drop or at least flatten out to reflect prospective economic growth. As that happens, we feel some of these underappreciated technology companies, some of these underappreciated growthy companies will perform at least in line with the market and provide some protective characteristic from a growth nature as the economy slows. That's one thing we're looking at for investors, is reducing our overweight to value versus growth in order to reflect where interest rates might level out because of this declining growth rate, because the Fed is actively coming out and pulling the punch bowl from the party by increasing rates. They have to, because inflation is going up. By the time you watch this video, we will have just gotten new inflation rates that come out and give us an idea of how far this is going. Now, some of the positive things that are there, unemployment is still very low. If you want a job, you are likely to be able to find a job, and your bonus is likely to be coming in. Your wage inflation is still likely keeping up with inflation, for goods inflation. Those are good things. Housing supply is still very low. So mortgage rates are going up, but if you Zillow around your neighborhood, there's not much available. And when supply is low and demand remains the same, housing prices can remain elevated. So while mortgage rates are going up, which means it's more of a hit to your mortgage payment on the bottom line, housing prices can remain supported for at least some time because of the low supply of housing overall. In the longer term, that's a dynamic that will impact house prices, but for the near term, we still expect to see elevated housing prices. There are other areas where we see economic growth potentially taking hold. That's in international and emerging markets. In emerging markets, certainly as we see less demand for goods from the United States, if we see lower economic growth, then we could actually see emerging markets take a little bit more of a hit. Of course, we saw that last year where they underperformed last year as well. So some of this is already priced in. But there are areas where there's more of a downside catalyst in emerging markets right now than previously there was when the Fed is hiking rates. At the same time, we have geopolitical risk that's rising. Not only does that affect demand, but that affects international, especially in Europe, where they need to find other sources of gas and oil because of what's happening with Russia and the Ukraine. They are seeing more of the supply chain driven inflation. All of those things may mean more of an impact on their growth than in the United States. One of our biases is to be more domestic in nature as a US investor. So to have more of your equity exposure in US markets over international markets currently, because we expect international markets to experience more impact from supply chain driven inflation and lower demand. So while there are some concerns to be had, we certainly see that with elevated volatility right now. The VIX index is at not historically high levels, but higher levels than usual, much higher levels than average. That's what we call the fear index. And what it's telling us is that investors are concerned about that downside catalyst right now. Much of this we think is reflected in markets. We think there are opportunities to be found, but at the same time, we're finding ways to help protect our investors from the downside catalyst while take advantage of those underperforming stocks that we think are the proverbial babies thrown out with the bathwater. So we consistently look for those opportunities. We're moving into some areas where we think the growth style may start to have a better performance relative to the value style. At the same time, interest rate duration is something we are starting to add a little bit to. Income orientation is looking a little bit better as rates go up, but it's still too early to go in and buy wholesale bonds as interest rates go up. We'll continually watch that dynamic and see when it's appropriate timing. And we'll continually look for good protective areas like adding potentially to gold exposure or other areas that can provide a good correlation in your portfolio that helps when systematic risk rises. You want something on the other side that offsets lower asset prices. So we look forward to speaking to you soon. Thank you for your time.